so it's well over 7,700 crore. And this particular deal happened at 2,201 rupees a share. We'll wait for later on, in the evening when the block deal data is updated on the exchanges as to who are the actual sellers and the buyers in this particular large block.
All right. I think we've got, just a couple of seconds to go as far as market opening is concerned, and then we'll get right down to it, look at indices, and then we'll look at individual stocks, etc., which are starting up. So it's flat. I mean, 20 points, 25,164 on the index at this point in time. So first rates coming up anytime now. As always, I don't think one can sort of ignore what's happening in the defense sector, defense space. One way or the other, there is so much news flow, global or local, and that keeps sort of hitting the tape. So keep an eye out on that pack. Otherwise, I mean, it's limited in that sense with some of the some more single stock kind of news, which is like Paytm, etc. What do we have? First rates, 25,132 on the Nifty. The Nifty bank is at 56,440, absolutely flat, unchanged. The Sensex is flattish as well. The small cap index is absolutely flat, 18,800. You got the mid cap index, which will come up on your screen, which is, it's a flat open across the board, no doubt about it. Market breadth right out of the gates is looking stronger, but we'll let that settle down a little bit. The heat map, will it be as kind of sort of flat as well, with not very much by way of change? Red, green will give you a quick sense of what the Nifty 50 stocks are opening up like. And then we will look at individual names where perhaps I think one can hope to find a little bit more in terms of price action, price moves. More down than up right now is what you have. Some 30-odd names are lower. Some 20 names are starting the day in the green. Surabhi.
Yeah, about 12 points lower on the index right now. Infosys, HCL Tech, Tech Mahindra. So IT is definitely driving it lower. Coal India is down. M&M starting off sluggish, 0.25% lower. And then there's TCS and L&T as well. So largely speaking, the problem for the market right now is only IT. Other than that, things are okay. In fact, Reliance was trying to pull the weight on the upside to counter the IT downward drift. Pharma seeing some buying. Market seems to be getting into a bit of a defensive mode. So Cipla, Sun Pharma, Dr. Reddy's, these are your big winners on the Nifty this morning. ONGC for obvious reasons, because crude oil prices have spiked up overnight, so 2% up on ONGC. Asian Paints, which has been in news because of this big block trade, it's moving higher quite nicely, actually. 2% up on Asian Paints as we see it right now. So that's pretty much where it is. But I just want to point out that I think the two stocks of the day, one on the way up and one on the way down, Paytm, look at the crash, 10% lower straight away, because there is no increase in MDR happening as of now. So that's on the way down. And on the way up, Sterlite Technology celebrating the BharatNet order. So it's all individual stocks that are getting the headlines today.
Well, that's right, Surabhi. A few more stocks that are moving quite well. Sterlite is up and about. You have Tanla. That stock as well is higher in today's trading session because they will be considering a buyback in the next few days. So that one, in fact, is doing well. SEPC, a smaller name, don't track it very often, but that stock, in fact, is higher because they won an order. I think ONGC as well as Oil India, both of them are higher in today's trading session. You have the positive rub-off from crude oil prices, so the street likes that. Explains why both those two are doing well. Let's pull up MCX as well. Lower volumes in comparison to April. Also, the NSE has got the green signal from the regulator to go ahead and launch electricity futures. Remember, MCX had celebrated that piece of news a few sessions ago. So that's pulled back a little bit. Let's pull up BSE. What is that stock doing today? Remember, yesterday it was a little bit lower, but I think in today's trading session, yes, it's down another 2.5%. So volumes falling out there. It's been moved into the ASM as well. Explains why that particular counter, is lower. And just pull up Vedanta as well as Hindustan Zinc. There seems to be a bit of a pair trade out there. Hindustan Zinc the last month has outperformed. Will it be Vedanta's time to shine from here on? We'll keep an eye out on both those two names. Hindustan Zinc, in fact, from yesterday's high actually had corrected close to 2.5–3% or thereabouts. So
Nigel, you mentioned the oil companies moving on the upside because of crude higher. That's ONGC and Oil India. But now the pressure is beginning to show on the downstream guys. HPCL, for instance, it's down 3%. They opened flat, but now there's pressure. HPCL is leading the pack on the way down, but even IOC and BPCL on the lower side today.
Okay, well, I think there is a fair bit which is coming on, and it's all about individual names, individual stocks, etc. right now. So BSE is the second biggest volume-led loser. I was talking about this in the, just before open. 28.30 on BSE after yesterday's, I think, 4% cut. We mentioned, of course, MapMy India, which is down 7. Paytm, of course, still down, was down 10, is down about 9%. Our power has had a breathless, non-stop, uninterrupted move, and our power is up 21% this month. It's up 65% this year. That is Reliance Power. It's down 1.5%, at least to begin the day. I think we mentioned CDSL. CDSL is down 2%, so 1,700 on CDSL at this point. Infosys is down about 1.5%. MCX is down about 1%. HPCL is down about 3%. BPCL is down 2%. So these are all essentially related to the oil price spike that we saw in a trade yesterday. And of course, the oil producers are the top gainers, Oil India and ONGC. Sterlite Tech has been a huge kind of sort of underperformer over the years. Is up 13% on this news flow. We'll see if it lasts or starts to fade. But that is what we have. Radico, I think, recovering a little bit. Radico is up about 2.5% at this point. I mean, I think sold off a little bit yesterday. So that's the bulk of volume-led moves that we have at this point. Market breadth is a little over 2:1 in favor of advances, 25,168. Gautam Shah is with us, founder at Goldilocks Global Research. Gautam, great to have you with us here on the program. Thanks very much for your time. So 25,116 basically was the top end of that range that we were looking at, and the market, had been in that range for a while, sort of broken out. But the argument is still on whether it is convincing enough, and there is enough in the tank for the market to make new highs on the Nifty. What's your sense? Has the road cleared up in that sense?
Good morning, Prashant. Well, yes, I think this 25,100 area has actually become quite popular. And I think a lot of people who track the Nifty and the large caps have become quite restless, in fact, even frustrated, because the headline indices have really gone nowhere in the last 3.5 weeks, whereas the broader markets have been in tear-away mode. This is classical bull market characteristics where you see market cap rotation, and I think this is going to continue going forward. As a technician, I always look for overbought signs or topping signs. I don't see any of that right now. I think the market remains structurally strong. We've obviously digested a lot of news flow in the recent past. The momentum is great. And you have the broader market indices a few percentage points away from lifetime highs. So given all of this, I don't think the Nifty can stay in its slumber for too long. 25,200 is actually now the working number that we are watching. And once that number is taken out on a closing basis, I wouldn't be surprised if the Nifty starts marching towards that level of 26,200, which is the lifetime high. So I think one stays bullish, ride the trend, do not overthink, do not overanalyze, and just participate in quality names.
Okay, Gautam, hi, morning. I missed the number. What is the close above what level that you think the march to 26,000 will start?
I think 25,200 is the important number for us now based on multiple technical studies. And once we see a good close past the same, I think we are headed towards 26,200 with a stopover at 25,600.
Okay, so basically a whole 1,000-point upside from here is what Gautam still sees is on the cards. That's good to know, because, every time we get into this prolonged consolidation, then mid-caps start falling as well, and then you wonder what's happening with the market. So now you spoke about sector rotation. So give us some more clues on this, because there have been patches where the old winners like defense stocks, they've still done well. Tell us what the charts are saying there, and where do you see signs of new leadership?
Well, I think the leadership clearly emerged from the banking space. I think the Bank Nifty has seen quality consolidation in the last couple of weeks, but still seems to be super strong on the charts. I think our near-term working target is about 58,000. And for a very long time, we've been talking about 60,000 on the Bank Nifty and the entire financial services space. So the banks, the NBFCs, and the insurance companies, the housing finance companies, I think they all look good. So I think if the Nifty has to break out, banks will have to participate once again, and it will probably trigger, the breakout. So I think I would be very, very bullish on the entire financial services space. And I think this is a trend for the rest of the year. This will be followed by metals and real estate, which has been our favorite all along. I don't change my views and preferences very often. So I think real estate and metals are on top of the list for me, and I think it will do bigger things. I think we will also see some participation from the IT space, which has seen some uptick in the last couple of days. So that's always welcome. But I don't think the IT index is going to be a big outperformer. And with Reliance having lost its underperformance, which is good news for the market, because even that stock could be gradually moving towards 1530. But the real opportunity is mid caps and small cap. Broader market is the opportunity, not now, but I think for the rest of the year. So forget the headline indices and focus on the broader markets.
All right. Hi, Gautam. I wanted to just come to that itself because that's what makes portfolio looks good, right? The headline index could consolidate a little bit, but broader markets have been doing a thing of their own. Tell us any kind of levels you're looking at in both the indices, the small or the mid-cap index.
Well, it's quite incredible that the broader markets witnessed a bear market for about 6 months, and the average decline in the overall market was about 40%. So we actually came out of that kind of damage. And today we are a few percentage points away from lifetime highs on the broader market indices. So I think the mid-cap 100 index, our working target is about 61,000, which was the previous stop. It could take a bit of a breather there, but once that number is taken out, I think a 65,000 is easily doable. If you look at the small cap 100 index, that's also setting up beautifully. In fact, the last 10 days, you are seeing a higher high every day on these indices, while the Nifty has been absolutely range bound. So I think that says a lot. But I think on the small cap index, our working target is about 21,000. So that's good 10% upside even from here. And I think you are seeing a relay of sector rotation even in broader markets. I mean, there are various pockets of the market doing well on a regular basis. We saw capital goods come back. Infra has done well. Sugar and paper have started to come back really well. So I think this is a good place to be in. And I think with US markets very, very strong, it just helps India do its own thing.
Yeah, I actually was just coming to that. The fact that globally as well, markets have just gone on, unfazed, right? Tariff issues, wars, falling bombs, drones. Markets have just continued to march higher. Do you see, anything changing in the global setup, the dollar, or whether it's the US 10-year yield and the mother market itself? What are those charts telling you?
One clear learning from the last 5 years is that the best opportunities are in the most difficult times. I think we saw that in the COVID period, and we saw that a couple of months back when we had the geopolitical scenario and people thought that that's going to derail equity markets. Did not happen, and I think markets beautifully held on to support levels. If you look at the US markets, they've also seen a beautiful V-shaped recovery in the recent past. The S&P is at the doors of 6150, which I think will be tested and probably will also get crossed. And I think many of the top stocks there continue to be quite solid. And in fact, even the Russell 2000, which is the broader market in the US market space, also seems to be doing well. So with the mother market quite safe, Europe in top form, Asia doing relatively well, and India having its own positives, and the fact that we are still 4 weeks away from the next earnings season, I don't see anything on the horizon that can really derail this market. So pausing and going up is good. I think every bull market has this beautiful framework of run, pause, and run.
And what about oil? That's a sudden surprise. $70, and the Americans are moving some of their personnel out of the Middle East, and suddenly everyone's looking at Iran. I don't know. Are the charts indicating anything ominous on oil?
Not really. I think it's seen a bit of an uptake, but we remain neutral to negative on oil. I think $63 to $75 is where oil is going to stay. And actually, as a technician, I'm very happy if oil stays range. So I don't want it to go up too much. I don't want it to go down too much. And I think it's going to remain this way. But I think the point that I highlighted in our last interaction, that the real opportunity is in the precious metals. While gold is taking a bit of a breather, look at what silver has done in the last 10 days. That's been our high conviction idea at Goldilocks for a while now. And I think it's ready to do bigger things going forward.
No, absolutely. Tilaknagar Industries, right? I mean, that's I think the big mover. It was not there in a big way when we started, but I think it's up 6% now, 7%. The graph should come up on your screen. So 370 on Tilaknagar and is, by the way, the fourth largest volume-led gainer on the NSE. The other one, which I think has picked up pace quite a bit, is Suvain. Suvain was again, it's gone up very sharply and quickly. So 268 on Suvain, 8.5% gain. And of course, I mean, I mentioned Tilaknagar, but take a look at Radico as well, which has picked up. It started higher, but it's up another 3%. It's basically up 3% on the day so far. It's really become about, it's become very disaggregated, Gautam, you'd agree, right? It's about individual stocks here, there, because the pickings are slim, so to speak. From a fundamental perspective, I don't know maybe how you look at it, how you look at things technically, but except defense, where there perhaps is a big tailwind, a broad tailwind, right, where you could sort of work to build, buy a bunch of them and kind of hold on. Otherwise, it's very disaggregated. Would you agree with that? And if yes, run us through some individual setups that you really like in the market, broader markets.
Well, absolutely. I think it's a stock picker's market. I think that's something that I've maintained for the last couple of months, because even if the Nifty does well and moves to lifetime highs, it's a 4% move. So it's actually nothing special. And with FD rates, on the downhill, it's very clear that more and more money is going to come into the equity markets going forward, given the stability and the strength of the recent past. So I think a stock picker's market is actually a good place to be in. Sadly enough, grade C and grade D have also done well in the last 2 weeks, which is a bit of a concern for me. But at Goldilocks, we only look at super solid companies fundamentally and technically. And I think the entire infra space looks very interesting to me, because if you have to play the India story, you can't let go of infrastructure and power. So I think these are two pockets that we like, and the top 4 or 5 names in both of these sectors look very good to us. I think they could generate 25 to 30% upside over the next 6 to 12 months. So that's something that we are focusing on in the broader markets.
And just to round the conversation up, what we started with, what about defense? I mean, does it still have some steam, or do you think there are some signs of fatigue or topping out here on these charts?
I think there are very clear signs of fatigue. In fact, I will want to believe that there is a greater fool's theory that seems to be playing out there. Anything and everything seems to be justified. And I think this has to end at some point of time. Not saying tomorrow, but I think these are not levels where you can make serious commitments in defense. I agree it's a great story for the next 5 years, but for investors, there are some amazing opportunities across the board. So why commit into defense? In fact, the entire PSU basket, the PSU banking basket, we like. I think that's a theme that's going to play out beautifully. Valuations are comfortable, charts are great. They're all coming out of 3 months of consolidation. So I would definitely recommend investors to look at PSU stocks seriously.
Yeah, no, absolutely. And PSUs, PSU banks, but not limited to defense, as Gautam said, perhaps is a way to go at this point. Sterlite Tech, 14% pop now. Reddington is coming up with about a 5.5% gain. Ajanta Pharma is up about 3.5%. HOEC is up about 2%. So lots of new names in addition to what we've been sort of highlighting earlier as well. Thanks very much, Gautam, for joining us. It's a pleasure. And always good to listen to you. Thank you.
Thanks, Prashant.
All right, let's now move forward and let's bring in the management of Tata Power. Dr. Praveer Sinha is MD and CEO at Tata Power. They've been aggressively, of course, focusing on solar manufacturing and renewable power. Their Tamil Nadu solar facility has crossed 4 gigawatt solar module production, and some of these developments and demand trends is what we're going to talk about. Dr. Sinha, thank you very much for joining us. Great speaking with you, as always. Now, solar equipment exports are looking very lucrative, according to many that we've spoken with. Will you explore this, sir? At the same time, US has imposed tariffs as high as about 3,500% in select Southeast Asian countries. As I preface my question, you have about 4 gigawatts of capacity. So exports an option?
First of all, thank you for having me on your show. I think what we need to look at is from a long-term perspective. There may be certain windows in which it may be very attractive to do exports of solar cell and module. But as we had mentioned earlier, we have our internal commitment. We have a lot of DCR modules that we need to supply. These are for third party as well as for our own projects. And we need to first cater to that. And then if we have some additional capacity beyond that, we will definitely explore the opportunity of exporting. But those will be, again, very small quantities and not very large quantities that we are looking at.
Hi, sir. Great to have you on the show. So, I mean, the question that we come back to is that how are you managing that ambition of net zero versus energy security? We understand that you're looking to ramp up thermal, at least in the interim. versus the prior aim of solely focusing on renewable capacity addition from here on?
So we have always believed that energy security and energy reliability are very, very important aspects. And that is why our initiatives on pumped hydro and some of the energy storage projects are going on. We do expect that we will be able to cater to the 24/7 clean energy requirement through the pumped hydro and the hydro projects that we are setting up in Bhutan, as also in our existing hydro locations. And if we get any good opportunity in other areas, we of course keep on exploring them.
Dr. Sinha, this is, of course, a question which comes up every summer season. Your view on India's demand-supply scenario, sir. How do you see prices panning out? Where do you see attractive investment opportunities? Are we well equipped to meet anticipated peak power demand, both short and in the longer run?
So I think the capacity addition that has taken place in the country in last few years has been phenomenal. Last year we had a capacity addition more than 30 gigawatt, primarily through our solar and wind projects. We do expect that going forward we will be in a position to meet our peak requirement. This year the target was 270, but I think we have not crossed 250 gigawatt. But looking at the type of capacity which is available, especially during the solar hours, we may not have any challenge in meeting the peak power requirement. The energy demand, again, is a function of the weather patterns. We have seen very different type of weather patterns this year compared to last year. We had a very rainy month of May, which was not anticipated. So let's see how the rest of the summer months pan out. But I can tell you that the demand of the country has been growing at an average of about 5%. And we do expect that going forward, this sort of demand will continue to be there, considering the extreme heat conditions in many parts of the country, as also the requirement from industrial and residential consumers. So the power requirement will continue, and we are quite confident that the requirement will give us the opportunity to set up more plants, more power evacuation, and more distribution opportunities.
Okay, got that, sir. Of course, renewables is a big focus area for you. What about the outlook for solar EV battery charging and the EPC business going ahead?
So the solar EPC businesses we have been doing for last many years. Of course, now that we have our own utility scale ambitions, where we will be adding about 2 to 2.5 gigawatt every year, our first focus would be to cater to that requirement, and only after we have catered that requirement, we'll look at third-party opportunities. And along with that, we, of course, are growing at a very fast pace in our rooftop business, which again requires not only supply, but also erection commissioning of rooftop for retail consumers right across the country.
Dr. Sinha, DISCOM privatization, again, something we've sort of spoken about this in the past. You've been keen. We understand you're looking closely at the Uttar Pradesh DISCOM privatization process. Can you tell us if, you indeed are looking at it, you're going to throw your hat in the ring?
So, from what we understand from the government, the RFP document is expected in the month of June. We would be definitely bidding for both the DISCOMs. I'm told that each of the DISCOMs have been categorized into 2 or 3 opportunities based on the geographical location. And we would be bidding for all of them. We are confident that based on our experience in Odisha, where we cater to both rural and urban areas, we are very qualified to do a similar work in UP and provide better quality service to the consumers of UP.
All right, got that point, sir. So obviously, I mean, your 2030 targets are fairly ambitious. You're looking to add a lot of capacity as well. So just give us some sense, I mean, in the near term, how are you seeing the trajectory on the top line as well as the margins?
We are very much on track. In fact, we may end up doing much better than our stated goals. And we keep on revisiting the numbers based on our actual performance in the years. And I think we are confident that not only we'll meet those targets, but also improve upon them.
Dr. Sinha, at the end of the third quarter, when we spoke to you, you spoke quite extensively about the opening up of nuclear power to private players. Could you tell us what is the status? Has anything moved? Any new interactions with the government?
So, from what we understand from the government, the amendment to the Act, both the Atomic Energy Act as well as the Civil Liability, is expected to go for approval in the Parliament, in the monsoon session of the Parliament. And we expect that thereafter the new rules and regulations under which the licensing will be done for the setting up of the plant as well as for supply of the raw material, that is uranium, and its processing will be done. So we are very confident that once we get better clarity on it, we'll be in a position to go ahead and implement some of these projects.
Okay, got that. So finally, let's get an update on Mundra as well. You're currently running on a cost-plus basis over there, and I think Section 11 is still in effect. Can we expect to see any long-term PPAs in the near future?
The plant is running under Section 11, and we have been engaged with the governments to come to a solution which is fair and reasonable to everyone. We do hope that we'll be able to strike a balance and finalize it quickly.
Okay. All right. Well, thank you very much for giving us all of the updates and the details on the business. As always, good luck to you and the team. We'll take a break on that note, come back on the other side, and we'll have Vinod Agarwal of VE Commercial Vehicles to talk about the May auto sales and the outlook for the rest of the year. Welcome back. Let's talk about Volvo Eicher commercial vehicles and the way those sales numbers have been shaping up. May auto sales have seen a healthy trend. Commercial vehicle sales trends has improved pretty much across the industry. Let's talk about the numbers at VECV as well. For the month of May, there's a year-on-year increase of about 7% for sales that the company has reported. We have with us Mr. Vinod Agarwal, Managing Director and CEO at VE Commercial Vehicles. Mr. Agarwal, thanks very much for joining in. So, it's heartening to see that for you and for players like Ashok Leyland as well, finally some green shoots seem to be occurring. Can you tell us which segment is showing revival? What do you expect? Because we're also now getting into peak monsoon, where mining activity pretty much, sort of comes down. So what's the forecast?
First of all, I think it's a very good sign that till now the industry has been doing all right, even though we would have expected slightly better growth rates, even though the industry is growing. So, like for example, in the month of May, the total CV industry 3.5 ton and above, the growth is around 4.9%. And even though we have grown by 7% plus, and YTD also we have grown by 16%, whereas the industry growth is still around 4 to 5% only. So first of all, we are continuing to do better than the industry this year as well as in the previous years. Then, of course, this growth is also due to some pre-buying happening because of the air conditioning that is applicable now on cabins from 8th of June. So therefore, some pre-buying also has happened. So we are expecting that the growth will continue because there are good fundamental reasons for this growth to continue. For example, the replacement demand we are expecting that will remain very, very strong. And then we are also expecting good monsoon. And we are expecting the economy to grow. And the interest rates are going to go down. As we have seen in the recent monetary policy, the interest rates have been reduced by 0.5%. So therefore, that's a very positive sentiment for the industry.
So Mr. Agarwal, all of these things put together, give us two estimates. Where do you see the industry growth, total CV industry for this year? And where would you be? I'm sure you'll be above industry, but how much above industry this year?
No, it is very difficult to pinpoint that how much will be the growth. We can only look at the trends and we can look at the fundamentals. So if you look at the trends are positive and fundamentals are strong. Therefore, we are expecting that the industry will grow. However, to say that how much it will grow, it is very difficult. My own broad expectation will be, it will be single digit only. I don't think we will grow beyond double digit growth. So it will be single digit, maybe between 5 to 10%.
But then you will grow in double digits, right? Because you're always growing above industry. Even the first 5 months trend, you're already growing 16%. Yes. So full year also we should expect double digit growth?
Let's hope. That's always the strategy,
Okay. Give us a sense on, like I asked, the segments and also what the bus portfolio is doing and which are the segments where you're seeing better traction.
Buses are doing very well. In fact, last year also the buses have already touched a new peak. Last year the total bus industry was 95,000, and we also grew very well in the buses last year also. We sold more than 20,000 buses last year, and this year we are continuing to do very well. In fact, first 2 months we have grown by 30% plus. So our market share in buses have grown significantly, and of course we are also expecting that the industry for buses will also continue strong because we are experiencing strong replacement demand from schools as well as from the staffing segment. And we are also expecting strong intercity coaches demand and also the route permits. So therefore, overall bus industry is expected to do well. And we are also expecting that the electric bus tender, which is going to be opened very recently now, 10,000 plus buses. So therefore, buses are expected to do well. And other than buses, light and medium duty trucks also have grown in first.
Sorry, sir, just to come in over there, this electric bus tender that you mentioned for 10,000 buses, this is coming in NCR, which is the state?
I think there are various states in that. It's not in one state.
Okay.
There will be a few states in that.
Okay. And since we're talking electric buses and EV, this whole rare earths, magnets, I mean, it's a huge issue for the passenger vehicle segment. I'm not quite sure if it impacts CVs or your particular electric commercial vehicle plans in any way or electric bus plans in any way. If you could tell us more.
So that's a big challenge currently going on for the entire auto sector. It's not only for CVs, it's for the entire auto sector. So therefore, I think through SIAM and ECMA, a lot of discussions are happening through Government of India and also our embassy in China. And so a lot of applications have been made to get the permissions from China.
So, sir, can you tell us specifically for Volvo Eicher CV, what is your current EV capacity? What is the ramp up you're planning? And will it impact your EV production?
For example, we still have stocks, there are always some stocks in the pipeline. So we will have stocks for around maybe 3 months, 2 months, our stock as well as supplier stock put together for magnets. Now, worst come to worst, if suppose these permissions don't come, then we will have to import the full component, because there is no restriction on import of full component. And if we import full component, then the cost will go up. So therefore, it's a big challenge. But of course, there are some magnets which are put in. For example, if it is put in some sensors, then that is not possible to import full component also. For electric vehicles, we can import maybe full motor we can import. But some of the parts of maybe passenger cars or for our trucks, that may not be possible. So therefore, it will be a challenge if the problem is not solved in next 2 to 3 months. So there is a lot of discussion happening. So let's hope that it will get solved.
Yeah, absolutely. Speaking of costs, give us an overview on other inputs, steel, other raw materials. I mean, how are input costs behaving for you, and what is the outlook on margins now as we go forward in the year?
That is another challenge, because government has put the safeguard duty on the steel,
Correct.
which is 12%. Now that is proving to be inflationary. So as soon as the duty was put, the all steel mills have increased the prices. The first quarter, the prices have gone up by almost 2.5 rupees per kg for steel. Now, of course, that is again a big challenge, that the safeguard duty is proving to be inflationary. So there again, I think the industry is in discussion with Government of India that the safeguard duty is not good for the industry. This is going to be inflationary. As it is, we are facing the inflationary pressures or cost increase pressures because of the additional cost of ACs. Now, the ACs are become mandatory, so we have to increase the prices. Because of that, now we have to increase the prices because of steel. So therefore, this safeguard duty, I think, is not good for the industry, for the auto industry. So these are the current challenges which are going on.
Got it, got it. So those magnets and the price of steel, of course, steel makers got that duty after lobbying for months and months and months. But as a consumer, I can understand your concerns as well. Thank you very much. It gives us good perspective. So thanks for joining in. That's Volvo Eicher saying 3 months of supply is there when it comes to EVs and these rare earth magnets. After that, the industry will have to see.
All right. Well, let's move to our next conversation. Premier Energies, that's the one on our radar. The large trade that did take place a couple of sessions ago, South Asia Growth Fund sold around 5.5% stake. Let's talk more about this trade and also how they see business momentum going ahead. We have with us Mr. Vinay Rustagi, the Chief Business Officer at Premier Energies, who joins in. Hi, Vinay. Good morning. Thanks a lot for joining in. Well, this large fund, they went ahead and they sold half of what they hold. Any kind of communication from them? Do they intend to hold on the remainder of the stake that they have? Or have they given you all a timeline that within this time they want to get out?
So sure. Good morning, and thanks for having me. As part of the process, the fund has given an indication that they will retain their balance equity for the next 5 years. For the next 5 months at least. In any case, I think, from our point of view, we are pretty neutral. What does the fund decide? Because we have a pretty liquid pool of large marquee shareholders, and the business is in a very strong footing, irrespective of what the fund decides to do with the shareholding.
Okay, all right. So for 5 months or that, I think that's a cool-off period as it is. So
That's right.
We'll have to wait by to see. But as you're saying, there's enough of interest in the stock, which brings us to the next question. You've put out a capex, a large capex, I think of around roughly around 12,500 crores approximately. Could you break it up for us? How much of it will be debt? I think you have some cash in your book. So if you could quantify that. And at peak, I'm looking at a brokerage note. They're estimating that your peak debt will be around 4.5 to around 5,000 crores. Do you concur?
So, those plans are still under development. You asked for the breakup of the capex. So what we are doing is we are currently almost doubling our capacities, what we have in terms of cell and modules. We are going up to 8.4 gigawatts and 10 gigawatts over the next 1 year. And then we are also going backward integration into ingot and wafer manufacturing. So together, the bulk of the capex, I would say 90% of the capex is going in these businesses. And then we have announced additional forays into battery storage and inverter manufacturing. And there we will consume about 800 crore rupees of cash. In terms of, you mentioned how we plan to fund this capex. So our intention right now, because the company is sitting on surplus cash, and generating a lot of cash in terms of internal accruals. Our intention is to fund this with internal accruals and some incremental debt. We want to be pretty conservative in terms of how we manage our capital structure. We want to stay at the boundary condition that we have set ourselves is about 1.5 times debt to EBITDA, which is very, very conservative given the overall industry dynamics.
So just to break this down, sir, you have currently 2,000 crores of cash.
Correct. That's right. Yes.
Internal accruals will be another, say, 4,000-5,000 crores approximately, which means that the peak debt that you will raise will be around 4,000 to 5,000 crores. Will that be a fair breakup?
On a net debt basis, the long-term debt should be actually even lower than that.
Okay.
I've got that. Vinay, hi, good morning. Prashant here. With you also in that analyst meet, investor meet, put out your projections of the demand, right, as you see growing.
Sure.
And basically you're saying that the current 25 gigawatts can double over the next few years. That's your broad projection.
That's correct.
This is 25 gigawatts for cell or module, Vinay?
So, Prashant, just to be clear, one thing what we are saying is that the current industry demand is about 24 gigawatt per annum. That's what India added in the last financial year. And our estimate is that given the growth momentum in the industry, we expect demand to grow to more than double over the next 5 years. Okay. In comparison to that, our current cell manufacturing capacity is about 25 gigawatts, and more capacity is coming online. And there our estimate is somewhere between 50 to 55 gigawatts over the next 3 years.
And that's the thing. So 20 demand supply are kind of evenly matched right now, right, in terms of solar cells.
No, so yeah. So let me just clarify. What happens is, what I'm saying, this current capacity of 25 gigawatt, that is the nameplate capacity. What you can produce in the best case scenario out of that is about 80%. So which would be about 20 gigawatts in the best case scenario. But the other complication is that a lot of the new capacity that comes online, it takes a very long time to stabilize and produce at optimal capacity utilization. So actual output that you get, whether it is current 25 gigawatts of capacity or let's say 50 gigawatts over the next 3 years, will be somewhere between 70 to 75% in the best case scenario. So our estimate is that the Indian market is likely to remain in balance or even undersupplied over the next 3 to 5 years.
And this 50 is 5 years, right? The demand estimate.
That's right, yes.
Okay. You don't think, so everyone recognizes, and I've spoken to many investors, not just about your company, but about the industry as such, that there's great visibility. And, your numbers, for example, show it. Fantastic numbers. And the numbers will keep coming maybe, this year, next year. But then suddenly, the fear is that there will be a sudden drop-off because there are very large players coming into the market. And as you said, only 75-80% will be the actual capacity. But the fear is that the plans are so large that even 75-80% of it will overwhelm the demand. That's the fear, Vinay.
Yeah, sure, Prashant. So I think I would answer that question in two parts. One, there is a very strong growth momentum in the solar industry. The battery storage prices have come down, which help address one of the biggest challenges of solar power. Solar plus wind plus storage is a very genuine and attractive proposition for all consumers, including discoms, and it can easily replace thermal as we go forward. So the growth momentum is very strong. The government has taken a number of steps to broad-based growth, going beyond discoms to the residential consumers, the agricultural consumers, etc. And second, we have not even factored in additional demand levers coming in from green hydrogen as well as exports. So if I take those things into account, particularly in view of the fact that the government is negotiating these free trade agreements, we believe that there is enough demand for all the suppliers who are entering this.
Okay.
So Vinay, exactly on the point of exports, and you mentioned in that investor call that exports remains quote unquote an optionality. While, of course, right now you're focused on the domestic market. And what you're telling us that 3 years you're fine in domestic market demand.
Correct.
Have you started thinking about exports and then which could be potential target markets that you look at?
No, of course. So we are tracking the international markets very, very closely. Currently, there is a little bit of an uncertainty given the tariff discussions going on and India's own free trade agreements. But the largest markets that we believe that will open up over the next 1 to 2 years will be US and Europe. And mind you, the demand in these two regions is more than double of India's current demand. So that is a very large potential export market which is opening up.
30-second response to this, Vinay.
Sure.
You want to become a vertical integrated manufacturer, right? So you're going to do wafers, ingots, etc. Is there any dependence on China in terms of technology, all these rare earth minerals, etc.? Any dependence, any bottlenecks as such?
So, see, in the current supply chain is based in China. You are right, but what we are doing as a company is we are trying to diversify away. We've got enough time. We've been looking at suppliers in other countries, mainly in Europe and US, and we believe that with sufficient planning and government support, we can easily manage that risk.
All right.
Okay, all right. Let's get a couple of numbers then, sir, before we let you go. I think you're guiding for a growth of around 15 to around 20%, if I got that correctly, on the top line. Is that correct? Revenue growth?
So as a company, we don't give out any guidance. What I will do say is that, our cell and module capacities are more than doubling over the next 1 year.
Yes.
And then we are entering into new business segments as well. So I can't give you any specific numbers, but we will have a strong growth momentum in the business over the next 2 years.
Since you're getting into backward integration, you can hold on to margins of around 32% or improve it?
See, again, I think there are a lot of variables.
You can give us a range, sir, because if you're getting to backward integration, ideally for any business, that means that margins will either improve or they'll stay constant, right? If you could give us a sense like that, I'm just going through a couple of numbers on an EBITDA per watt as well, very, very roughly. For the last quarter, you would have done around 5.8. So can you hold on to something on that vicinity?
See, I'll answer that question in the industry context, because as a company, we don't give out any guidance. This is an industry where the technology lifecycle is changing very, very rapidly. And CapEx, it's very, very capital intensive. So for a business which is profitable, which wants to grow and invest, the typical return on capital that we expect is about 25%. And that is where we would want to be over the long term, but the ultimate margins will depend on a number of market factors.
Okay. All right, Vinay, we'll leave it there. Thank you very much for joining us. Good speaking with you. Appreciate it very much here on CNBC-TV18. Well, we're going to come back and get you an exclusive preview of a conversation my colleague Shilpa Ranipeta had with Gautam Singhania. That's coming up in a bit. Stay with us. Okay, welcome back. 70 points lower. So there is a bit of a drop-off which has happened. 25,076 is where we find ourselves at. Mitesh is with us with what he'd want you to do in terms of index and specific trades. Mitesh, take it away.
What do you think, Prashant? Not much on the index. In fact, I'm slightly worried that the breakout isn't getting any kind of follow-through and trailing stop losses have been hit. Though we haven't turned negative as yet, I think the overall setup isn't very confidence boosting. So we'll avoid the index. On the stock side, I have a sell on HUL. I think multiple times what we saw was that the stock failed around this 2390, 2400 levels and is turning down. So we'll take a tight stop at about 2375, look for a target of around 2300 on the downside. And pharma names are looking good. That's the sector, which is showing some traction. So Sun Pharma is a buy. Keep a stop below 1700, look for targets of around 1760.
Okay, I got that, Mitesh. I remember you said the Nifty stop should come in at 2085, and the Nifty is just at those levels right now. So let's see how this plays out. Thanks for the advice. We'll come back to you later in the course of the day. For the time being, let's quickly shift the focus to the commodity markets. We have Manisha joining in with the latest. Manisha, what's the headline?
The crude oil prices and the kind of run-up that they have seen absolutely is a headline. The Brent price has gained up by 4.5%. It was almost 5% of gains coming in for the U.S. crude prices also. So while you have the Brent prices trading at a 2-month highs, the U.S. crude oil prices are trading at a 10-week highs on the international markets right now. Well, if you look at the Brent prices range, it has been quite a big one. We started this year with almost at around $75 a barrel, a high at around 82. We've also seen a low of $60 a barrel in this year itself, and then currently trading at around $70. So we're trading somewhere in the middle of the range, as it were, for the crude prices. Various supporting factors then, and four major. One is the rising tensions between US and Iran, especially with the kind of statement that Iran has been putting out, saying that it will strike the US air bases within Middle East if the nuclear deal does not go through. And we have seen US react to it as well by partially evacuating their personnel within the Middle East there. So this doesn't seem to be going away in a jiffy, and that's adding premium to prices there. The second important thing clearly has been about the US-China trade agreement conversations. There is an expectation that we could see the final paper very soon, and that has been supporting prices. The U.S. Federal Reserve could also be cutting interest rates in the next meeting. What is the idea that the markets are taking out with the kind of inflation data that we have seen come in from U.S. yesterday, slightly softer than what the street was anticipating, and is the reason you saw the U.S. dollar index as well decline. The dollar index, by the way, is down by 2.5% in this year itself, in turn supporting many of those prices. And the final point is about the U.S. crude stocks, which also have continued to decline. Markets were anticipating a 2 million barrels of a decline, and we've seen 3.6 million barrel actually come in, and that in turn also led to some gains into the prices. I also want to show you on what we've done in sense of prices in the last couple of months. Then April wasn't such a great month. We saw 15% of a cut coming in for the crude prices, but last month was 11% of a jump, and this month already 8% of gains is what the crude prices have given you. Also, when you look at the last couple of years, it hasn't been so great. We've seen 10% of a decline in 23. 2024 was 3% down, and this year, while we of course have led to some gains into the markets, at one point in time we were down by nearly 15% in case of crude prices, but just about 5% down for this current year now.
Yeah, no, absolutely. Thank you very much for that. So oil suddenly is taken the top slot as far as mind space goes, and as the top story as well. Let's get you a CNBC-TV18 exclusive now. My colleague Shilpa Ranipeta caught up with Gautam Singhania, the chairman of Raymond Group. Shilpa asked him about his plans for the group's engineering business. And, it's a long interview. We're only playing a small snippet of it. And we're, of course, focusing on engineering because that is the less talked about business. But he also spoke about his succession plans for the group. Listen in, as I said, to a small excerpt of that conversation.
Right now, everything is a subsidiary. We're going to make aerospace one subsidiary and real estate, auto components and engineering as separate subsidiaries. So
right.
Currently, it's a subsidiary. We'll be split into two.
Right, fine. And you stated a while earlier when we were speaking about how there is huge opportunity in this space, right? Where will it come from? Will it come from the aerospace or defense?
Aerospace is big. Make in India is a big opportunity. So I think similarly, we're back to the China plus one story. I mean, companies are saying that we need to have presence in India.
Right.
India is a space we have to be.
And even for this Raymond Limited now also going forward, the top line and the EBITDA targets that you have is the same 20% and 15%? Stated for every group. What are the kind of projects that you're looking at in the automotive and in the aerospace and the defense space, where you've stated that there's a lot huge opportunity?
We're looking at a lot of stuff. It's premature to talk.
Okay.
We got the Paris Air Show next week. So let's see what comes out of that.
Right.
It's a very big show, a lot of people there.
Right.
I'm going to be there next week. So I think there's a lot of opportunity. Let's just keep our fingers crossed and hope for the best.
You know, now we're talking about you've been running this business now for 25 years since you took over?
More. I've been running it. I've been in the group for 45 years.
45 years, okay. I mean, at the very helm as the chairman.
26 years.
Now, when you look forward, how are you looking at the succession, Mr. Singhania? Are you also looking at bringing your children into the business?
My kids are too young; they're not going to come in. Which is why I've got professional boards, professional management. Everybody's incentivized.
Right.
My daughter's 20. I don't think she's coming in for at least 5 years if she decides to come in. So we've got to professionalize the company. We've got to protect the shareholders. And that's what we're doing, which is why you're seeing this whole split up into 3 companies, 3 top-class boards, 3 sets of governance, best-in-class governance, best-in-class management, and that will ensure that, I have to differentiate between management and shareholders.
Fair enough.
I have to move back as a shareholder and get the best-in-class governance, which eventually, if I get good return on my shareholding, that's wealth creation for my family. So
fair enough. So there's no thing about you want your children to come in that is completely...
That's a personal discussion. We can have that some other time.
All right. So the agenda is to professionalize the boards of all the 3 entities at the Raymond Group. The children will take their own call whether they want to join the business or not. That is Gautam Singhania. Well, on that note, we have to take a very quick break. Come back on the other side in our special segment, It's the Economy, coming up. It's actually Indianomics today. Lata is going to be in conversation with former RBI deputy governors and bankers on whether RBI is moving towards lowering restrictions on banks.
Welcome to Economics. Does the massive CRR cut of 100 basis points indicate a trend in Reserve Bank to remove constraints on bank profitability? That's our debate today. And why am I asking this question? In the past 5 years, bank deposits have risen just by an average of 11% a year, while the assets of mutual funds have risen by an average of 30% per year. Also, banks are fast losing long-term deposits or stable deposits and are having to pay much more for term deposits. So is the CRR cut intended to remove some of the costs imposed on banks? Historically, Indian government and Reserve Bank have imposed many constraints on banks. They have kept CRR 4% of their deposits as idle cash. They have to invest 18 to 20% of their deposits in government bonds, which give you very little returns. And they have to mandatorily lend to weaker segments like agriculture. But now that banks are not getting enough of lazy deposits, is the Reserve Bank leaning towards making life a little easier for bankers by cutting the CRR? That's my question. And joining me is a veteran cast of bankers, two former deputy governors, Mr. H.R. Khan and S.S. Mundra, and former SBI chairman Dinesh Khara. Also joining us is Harshvardhan, the banking expert from Bain & Company. Gentlemen, thank you very much indeed for your time. Mr. Khan, I'll start with you. I think you have got a 50-year association with the Reserve Bank, and I have covered it for 30 years. You tell me, I have never heard this 1% cut in CRR except during the Lehman crisis. So does this signify a different kind? It is more a banking regulation rather than a monetary policy move.
No, thanks, Lata, for getting me. It's not 50 years, it is slightly less than 40 years, my association with Reserve Bank. So coming to your question, whether it is meant to provide some leeway to the banks for their deposit mobilization, we know the background under which banks are functioning in terms of deposit mobilization. I would say this is not the direct objective of this massive CRR cut, just to help banks to garner deposits, but this would be a byproduct, because with massive rate cut and CRR cut, there will be pressure on NIM, and CRR cut will provide some offset to that, and they will be in a position to maintain some semblance of rate in terms of giving to the depositors. As you know, in Indian context, still we have a positive rate of return. So there should be a natural tendency towards deposit mobilization. But as you have seen, the way people are moved towards capital market and the massive flows which are happening to mutual fund, this is having impact on the bank deposits. So at margin, this CRR cut will help in offsetting their impact on NIM, and that will help in giving little more in terms of cut in the lending rate, not so much in deposit rate. I think the whole purpose is to increase credit flow and reduce the cost of credit. I think this is going to be impacted positively by this.
I take your point that, there is better monetary transmission because of CRR. But Mr. Khara, you come in on this. There are a zillion ways that the Reserve Bank has to improve liquidity and transmission. I mean, they can do OMOs, they can do FX swaps, they can simply give a bigger dividend to Reserve Bank, they can do long-term repos, the TLTROs that they did during COVID. RBI can create money from thin air if it wants. Why is it deliberately doing something it has never done before? A 1% CRR. Is there an eye that banks need to be commercially profitable?
I think I would like to draw your attention to the fact that around the COVID, the CRR was actually increased. And this was actually long overdue as the CRR readjustment was concerned. And apart from that, it has to be seen in a little different context also. We have seen that all the developed economies normally have got the lower CRR. So actually, when you look at it, the financial system in the country, it is actually evolving to becoming a very developed one. As actually speaking, many of the advanced countries also don't have the financial system as strong as and as robust as perhaps India has. So I think in that context, there was a room for CRR reduction also. Having said that, what you mentioned in terms of if at all transmission has to be expedited, then perhaps this was warranted, because unless and until the NIM aspect of the banks have been addressed, there would have been a challenge for banks to raise the capital. And today, as you're aware, that many of the global participants are very much there as a shareholder for the banks. So having said that, I think this must have been there at the back of the mind. If at all transmission has to be expedited, then unless and until there could be some kind of a relief given in the CRR, which will help in reducing the cost of funds for the banks, and also it will help in transmission, which will eventually help in the growth of the economy. Perhaps these were the considerations why it was looked at.
Yeah, you're making a new point about capital also. And actually, I've heard this from the Reserve Bank higher ups, that we have to think of capital as well, so that, banks are prepared for a continued 7% growth. Mr. Mundra, you have actually been both in Mr. Khara's chair and Mr. Khan's chair. You've been a chairman of a bank and a central banker. You tell me, would you look at this as something different? This is not to be taken as just a liquidity step. It is also a banking profitability step.
Okay. Lata, thanks for having me here. And first, let me start with challenging both of your premises.
Okay.
Really, I don't agree with that. Why? Number one, profitability of the banks are at all-time high at this point of time. So I don't think that there is any concern around the profitability. And the second premise, that by cutting the CRR, banks will have the ability to, say, on deposit front and all that. But let us understand, this is one-time measure. Okay, you give CRR today, it maybe enables the bank for a few months or for a year. But ultimately, race is on forever. And it is a matter of fact that the whole dynamics in Indian system has changed. Banks will no more have the luxury of having what you call as a lazy deposit or those kind of term deposit. The shift has come to remain forever. So I think for that, banks will have to be more smart. Probably the bank who can manage more money in transition would be a winner. And at some point of time, like any developed economy, market forces will also come into play where funding will be done. So I started with these both premises, but then little bit, then what could be? I see 3-4 clear things if I read at the policy. Number one, I would like to say with successive policy, I think the footprint or the imprint of new governor is clearly seen in the communication. There is a subtle change in the communication in the policy. February policy was too early. He had just come into the saddle. But April and then now June policy, one thing is coming out very clearly, that the market participants are getting a much clearer communication and much clear roadmap. To be brief, we have time, we will elaborate on this point. But the second thing, I think both in monetary policy resolution and governor's statement, there is a clear call that the private consumption and private investment should now take over. There could be, government cannot keep on doing the heavy lifting all the time. Transmission should be better, while it has reflected in the short term, but it is yet to reflect in the credit pricing. So that message is also very clear. And again, there is a lot of clarity that the stance should not be confused with the management of liquidity. These are two different things, and they would be handled in a different way as per the evolving situation. So I think I take it like this. Important point, the private consumption and investment is spur and a better transmission. Those will be the thing. I won't see it as a sea change coming in the regulatory stance. I think regulatory stance, there are so many things in the regulatory stance, which includes, how you treat the customers, how is your control systems, how is your cyber security. All those things would continue to remain on focus and on. Of course. Let me pause here.
Yeah, no, I agree. I maybe the word profitability is poorly chosen by me. But my point is, I have not seen 100 basis cut in normal times. And that's why I'm asking whether they want to put fewer constraints on banks. Time was when banks were an extension of the fisc. I mean, they did everything that the fisc did. Slowly, we started listing the banks, and then a priority sector was also made on market rates. Otherwise, priority sector loans had to be given at fixed rates. So, to you, Mr. Harshvardhan, would you agree that this is showing a sea change or certainly a step change in Reserve Bank's attitude to banks that, they have to be commercially viable?
Yeah, but Lata, I go with Mr. Mundra. There was no question of commercial viability. I mean, last year was the highest profit on record, 3.5 trillion for Indian banking system. So even if you imagine 25, 40 basis point compression in NIMs, which I am expecting,
yes,
this year also will have a substantially higher profit than what we've seen in the past. So I don't think profitability was a concern. Balance sheets of Indian banks are as strong as they ever have been. So there is no capital question, right?
So in that case, what is your guess as to why this extraordinary step?
This is a tacit recognition of the RBI that deposit market still remains very tight and it is likely to remain so because the underlying drivers of that tightness are structural. They are not going to go away anytime soon. So this is, and remember, other tools of liquidity infusion like OMA and all are selective. Only few banks get it. This is system-wide. So this is like Brahmastra. This is final instrument that has been used. Now we are at statutory minimum on CRR. So I think I also read a little bit of a hidden concern about a slowing economy that RBI has. So they have basically taken very, very aggressive policy action, both on CRR and the policy rate cut, probably because they are concerned about the economy slowing down. And however, remember, credit growth has never been slow because of supply side issues. The demand for credit itself is low. As Mr. Mundra was saying, private capex has actually collapsed. And I don't know whether 50 basis point cuts is going to rejuvenate it. I will hold my opinion on this one. In the short run, I don't think that's going to happen. So I don't think this is going to spur credit growth. What you might see is the 1%, 2.5 lakh crore going into SLR initially, because I don't see any significant business credit pickup. The consumer credit and all of it anyway coming down. So I think it's partly very aggressive action to spur credit growth, as Mr. Mundra was saying that the private sector has to do heavy lifting now, and partly recognition of the fact that deposits are really going to remain out because of household savings falling and so on and so on. That's how I read it.
Okay. Well, I don't know if we should look at a 6.8% GVA that we reported in the last quarter as really all that slow. 7.4 GDP I'm not taking, okay, because it is net taxes. But 6.8 in the fourth quarter doesn't look like an economy that needs a bazooka of, 50 basis and 100 basis cuts. This is, something out of character with the Reserve Bank's DNA. And I want to pose that question again to you veterans after the break, whether we will see more steps. After all, we don't get lazy deposits. And therefore, should you also give banks less responsibilities in terms of weaker sections, priority sector? Will we see more of this kind of behavior from the Reserve Bank? Those questions after the break. Bazaar viewers, you will get to see the entire chat after market hours. For the moment, for you, it will be Chartbusters.
Invisible Mr. India Watch? So Miss India Watch होगा ना मेरे लिए. If I anchor without A slew of block deals on our radar. Asian Paints trades higher after shares worth 7,700 crore rupees change hands, while Eternal trades marginally lower after a block deal. MapMyIndia, on the other hand, falls over 7% as 28 lakh shares change hands. Sources say PhonePe likely seller.
Shares of Oil India and ONGC rise on the back of surging crude oil prices amid escalating West Asia tensions. Brent crude prices hovers around $70 per barrel mark, hitting the highest levels we've seen in the last 2 months.
And Paytm falls as much as 10% following the Finance Ministry's clarification on reports about possible introduction of a merchant discount rate on UPI transactions.
Shares of Sterlite Tech rise over 10% after signing a JV